Okay, so now we know what flags look like. What we now must do is learn how to trade them, know how to place our entry orders and our stop placements so that we can maximize our profits and minimize any risk that goes along with it. Now, here's our bull flag pattern. The first line I'm going to draw is our conservative entry target, which is at the top of the entire pattern. This is at position A. This is where I would look to buy this stock as it breaks out of the entire pattern, as it clears it and goes just above that entire top. We would go and buy at A. This reduces our risk of having to fall foul of a double top. That's why I like to go at A, which is just above the top of the entire pattern. However, if the markets are very bullish at the time, we could enter at B, which is at the top of the little consolidation area. Now, sometimes these will be at the same place, and sometimes if the stock has drifted down a bit in the consolidation, then B would be a valid entry target if the markets are rampantly bullish, number one, and two, using the OVI, if the OVI was positive too. Now, the only risk with B is, of course, if the stock goes up, hits a double top at the top of the entire pattern, and then comes back down again. But if you've got a rampantly bullish market and you've got the OVI in your favor, then clearly you've got more chance of that not happening and getting a good clean breakout. So what we do is we put in a buy stop limit order to open either at A or B. A is more conservative, B is more aggressive. Underneath that, we then place our stop loss. Now, we typically put our stop loss underneath the entire pattern. However, what we can do is if we went at A, for example, we could tighten the stop loss. So if you're not sure and you've gone at A, so you've placed your trade at A, which is above the entire pattern, what you might want to say is, look, if this stock comes back down into the flag itself, I don't want to be in this trade anymore. I would like to get out with a much lower risk. And so you can raise that stop loss so that you minimize that risk. Now, what will happen, of course, is that you'll be stopped out more often. So the tighter your stop loss, the less risk you have on any trade, but the more often you're likely to get stopped out. So if you wanted to buy 100 shares, what would be your practical risk? Well, of course, if you buy a share, your risk is that the entire thing could collapse to zero, but that's very unlikely to happen when we trade bull flags. It's very unlikely to happen because we've got no news ahead, because you've already filtered away for that. And you've also got a bullish pattern and a breakout. So you've got lots of things in your favor from the get-go. But if you wanted to buy 100 shares, what would be your practical risk? Well, let's have a look. Let's just say that if you entered at A, the difference between A and your stop loss was $1. If you bought 100 shares, your practical risk would basically be $100. If you were to buy at B, let's just say the distance between B and your stop loss is only 75 cents, then 75 cents multiplied by 100 shares is $75 of practical risk. Now, this is not your absolute risk. Your absolute risk would be if the stock went to zero, but very unlikely to happen. So your practical risk with these flag patterns is very low. And of course, we can make that even lower if you traded at A by pushing up that stop loss to the position B or just below the position B inside that actual flag area. So you can really mitigate your loss, minimize your risk as we trade these kind of patterns. That's what makes them so powerful. So if we wanted to only risk $100, how many shares would we be able to buy? Well, let's have a look at the calculations. If we were to buy at A, we would say $100 of risk divided by the distance between A and your stop loss, which is $1, equals 100 shares. That's pretty nice. What happens if we wanted to risk only $100 but trade from B? Well, that would be $100 of risk divided by 75 cents, which is the distance between B and your stop loss, equals 133 shares. So of course with B, we would have the opportunity to buy more shares and still risk the same amount. Now, of course, if we were traded at A, we can always move that stop loss up, and that would enable us to trade a few more shares as well. So let's look at our old friend, the bull flag rising wedge. Now, it's not really our old friend because we don't like this, but now I'm going to put it into context as to why we don't like it. Where would you enter this trade? Where is the clear area of resistance? There isn't, because we don't have a top of the flag, which is a clear area of resistance. We don't have a top of the entire pattern, which is a clear area of resistance. What we've got is a drifting up. We don't have any clear areas as to where we enter our trade. Not only that, but we don't also have a clear area as to where we put our stop loss either. So this is why we don't like rising wedges in the context of bull flags. Let's now look at bear flags. So here's our bear flag, and we could either enter our trade at the bottom or just below the bottom of the entire pattern at A. That would be our conservative entry point. Or we could enter it at B. So let's just say we had a rampantly down market, bearish market, and the OVI was pointing down. We might want to place our trade at B, which is just below the actual flag bit, the consolidation bit itself. Now, sometimes that will be the same as A, and sometimes if that flag has drifted up, then it'll be a little bit above A. So B is more aggressive, A is more conservative. We place our stop loss above the entire pattern, so right here, so above the consolidation, just a little bit above that, and that is our buy stop loss at that point, because we sold short. To reverse the trade or to close it, we would have to buy back what we've sold. Now, of course, if we do sell at A, what we can also do is we can push down that stop loss so that if we've entered at A and we don't reach our profit target, we can minimize our losses. Now, where we would put that stop loss, if we were going to adjust it, would be just above the area where we would have entered if it was B, so just above that consolidation area. Now, if the markets are choppy, that would be the time to do that so that you don't have to absorb too much risk. So let's now look and see how many shares we could short in terms of our practical risk. You've got our sell points there of A and B, or our sell short points, that is. And if we wanted to sell at A, the difference between A and our stop loss, just say, is $1. So with $1 and 100 shares, we would be risking $100. If we were to trade at B, then the difference between B and our stop loss area is only 75 cents. That means 75 cents multiplied by the 100 shares that we're shorting would mean only $75 of practical risk. Now, there are certain niceties about trading short which I will get into in due course. And as we saw before, we can move that stop loss down. So if we were to trade at A, we could limit the loss very considerably by pushing that stop loss down.